Today, we're going to be discussing self-directed IRA basics. So IRAs 101. I'm looking forward to taking you guys back to the basics because oftentimes we jump into these more complex scenarios, or we have this concept that self-directing is challenging, when in reality, if you take it step by step with us, it's quite easy. So I look forward to sharing with you guys how to accomplish self-directing, as well as answering any questions you may have throughout today's webinar. We encourage everybody to enter in some questions to the chat or into the Q&A portion of your Zoom. We openly answer questions throughout the entire session as well. So we really appreciate you joining. We appreciate your engagement, and let's jump right in. Throughout today's presentation, I want to just remind you guys that this is not legal, tax, or investment advice. So we're not here to endorse any particular investments. We're not even here to endorse any particular type of retirement account per se. We're simply here to educate you and let you know what's possible. Let's talk a little bit about what we're going to cover today. Today, we're of course going to be covering what the heck is a self-directed retirement account. We're also going to talk about the different types of accounts that can be self-directed. We're going to help you also walk through how to determine which account type is best for you. We'll talk about moving money to your new self-directed retirement account. How does that work? Moving money from your current bank or your current IRA elsewhere over to your new account with us. And then we'll also talk about how to make your first investment with an example in real estate. We'll be looking at a long-term rental that Daniel has in his Roth IRA. Last but not least, we'll cover some tips and tricks on how to make sure everything goes smoothly. So without further ado, let's jump right in. So what the heck is a self-directed retirement account? A self-directed retirement account at Directed IRA is legally the exact same as an IRA at Fidelity. A lot of people think that when they hear that term self-directed, it's a unique type of retirement account in a way that might change the legality behind it. When in reality, a Roth IRA at Fidelity is legally the exact same as a Roth IRA with Directed IRA. There's only one key difference, and that's the investments that you're allowed to actually invest into through your Roth IRA. For example, Roth IRAs at Fidelity, you've got your stocks, bonds, and mutual funds. As opposed to a Roth IRA that's self-directed with Directed IRA, we actually allow you to invest in the fun investments, real estate, crypto, gold and silver, essentially anything. Let's talk a little bit more about how they're the same though. The Roth IRA at Fidelity and the Roth IRA with Directed IRA are, again, one and the same. They're treated legally the same per the IRS. This includes the same contribution limits, the same rollover rules, the same transferability, as well as the same tax forms filed as well. So as you can see, all of that is exactly the same, whether you've got an IRA at Fidelity or Schwab or wherever. If you're doing contributions there or rollovers and transfers, we can do the same exact thing for you here. None of that changes just because your institution changes. So everything is essentially the same. There's just that one key difference of what types of investments are allowed. Let's talk a little bit about that one single difference, and that again is the investments. So what you will learn throughout the course of today is that the Roth IRAs over at Fidelity, they're likely going to be invested in those traditional assets, or kind of boring, right, Daniel? I think they're a little boring, but that's just me. We like to make sure that people are aware that you can diversify and also hold things outside of the stock market in your IRA. So we're excited to jump in with that with you today.
So I would also just elaborate on one other thing, is the self-direction portion. Mm-hmm. That is just you going out and finding the deal. I always let my clients know you could actually self-direct with Fidelity and Schwab. It's just you're only going to be able to self-direct right into stocks, bonds, and mutual funds. So while we're doing alternative asset investing, we're allowing you to go out and pick whatever you'd like, except for we didn't mention just two things you can't self-direct into, which is collectibles. Mm-hmm. So you guys can finally get rid of your Beanie Babies or Labubu's. I think we're doing now. We're doing Labubu's. Yeah. So those are going to be taxed, okay? So you can't do collectibles and you can't do life insurance contracts, which that would just those make for really short true crime documentaries, so you probably want to stay away from those anyway.
Yes, those are the only two types of investments that the IRS says, no, you can't do these in an IRA. So no collectibles or antiques and no life insurance contracts. So what does that mean? Everything else, fair game. Absolutely. Just showing you guys a couple of examples of those different types of investments that you are able to do. As we mentioned before, when you've got your account with a Fidelity or a Schwab, you can quote unquote self-direct into stocks, bonds, and mutual funds of your choice. But that's not true self-direction. True self-direction allows you to invest in what you know best or alternative investments. For example, if you're a real estate investor, why not invest in real estate with your Roth IRA? That's a possibility with your self-directed retirement account. So as you can see, the lengthy list on the right, that's not even all inclusive, guys. That's a teensy little sample of what you can actually invest into. Daniel, do you have any honorable mentions that we don't have on that list? We've got real estate, crypto, land options, gold and silver, private lending, private company stock. Did I miss any big hitters?
No, I would elaborate. I mean, we have actually a webinar where we discuss about Peter Thiel's IRA and how he went right into private businesses and private equity. I would also like to elaborate cryptocurrency. That's one of the accounts that we have opening up day in and day out with us. Probably getting to be one of the bigger ones. I don't know. I know real estate's pretty big with us, but cryptocurrency is one of the larger ones as well.
Absolutely. Real estate is still number one because there's a lot of different types of real estate that you can actually do. But you're spot on. Cryptocurrency is on the rise. It always ebbs and flows with the market too. Bitcoin's been giving me a little bit of a heart attack these last 90 days. So I'm just
I think it does every holiday season. Cryptocurrency gives the whole entire family a heart attack, whether it's the conversations at the dinner table or actually what's going on with your bank.
Doesn't understand what cryptocurrency is, but that's okay. I don't think many people do. But to the point of the diverse investment options, as you can see, it's an endless list, guys. We even have someone that has purchased cattle, so you can go out and buy some cows with your IRA. So the sky's the limit. Get creative. Let us know what you're thinking. Drop that in the chat if you have any questions as far as different investment ideas that you're kind of pondering right now.
I have a client who's buying a plane.
Oh, that's
I don't know
cool.
if I'm allowed to talk about that, but I've heard some crazy things.
That's pretty awesome. A plane. I wonder what he's going to do with it. Well, the good news is, guys, is that even with all of the stuff that the Roth IRA at Fidelity allows you to do, those stocks, bonds, mutual funds, and ETFs, you can do all of that with your self-directed retirement account at Directed IRA as well. So not only can you invest in real estate, crypto, land options, gold and silver, etc., etc. I could go on and on. You can also do the good old stocks, bonds, and mutual funds. So we have a lot of clients that'll leverage both options. Again, diversification is always key, but having some closer to liquidity when it comes to those publicly traded assets is something that a lot of our clients do to diversify. Let's talk a little bit more about those investment options. Again, we've got real estate, crypto, gold and silver. The sky's the limits. And as Daniel previously mentioned, there are two investment types you cannot make. That's going to be your life insurance contracts and your antiques or collectibles. There is one other type of investment that an IRA cannot make. Pop quiz. Daniel, do you know what that is?
S-Corp.
There we go. Why is it not permissible?
Because the only people who can invest in S-Corp are just that, people.
Exactly.
IRAs, while they are entities, they are not people.
Bingo. So even though the IRS doesn't actually list S-Corps as something that you're not allowed to invest in, the S-Corp by nature has to have an actual person. That's one of the principles. So can't own the S-Corp shares in your retirement account because it's considered an entity.
But that can't stop you from doing private equity. You can still go right into those private businesses.
Absolutely. Private equity is absolutely still an option. I've actually got some money in a private equity fund myself. So.
I'm looking at one right now.
Ooh,
Yeah,
awesome. We'll have to chat later.
So.
Yeah. Let's talk about that one later. Always looking for some new deals. Love it. All right. So again, you can still do stocks, bonds, mutual funds, but then you've got all this fun stuff that you can also do with your self-directed retirement account at Directed IRA. All right, let's jump into what types of retirement accounts can actually be self-directed. What you're seeing here are the three most common types of retirement accounts that are self-directed by individuals. We've broken this down into two different types. For individuals, and for small businesses. So what you're seeing here is something that everybody with earned income with a United States issued Social Security number is able to contribute to. So if you've got that earned income, you're welcome to utilize a Roth traditional or HSA. Now, there are some rules that you have to follow when choosing your retirement accounts. So we always encourage everybody to book a call with us, to chat with us first, just to make sure that we're watching out for those things for you and alongside you. I always want to make sure I encourage you guys to book a phone call. So I know I haven't said it a ton earlier on, and I apologize, but this QR code is going to appear throughout the overall presentation. The sooner the better. Scan that, book a call with Daniel. He'll be happy to walk you through all your 101 questions, even your 201 or your 301 questions. He's been getting into some of that advanced stuff over the last few years. But book a phone call with Daniel so you can ask him one-on-one questions that are specifically catered towards you and your needs. But what you're seeing here are the three most common types of retirement accounts that we see opened up on a daily basis for individuals. You've got your Roth IRA, your traditional IRA, and your HSA. Now I want to focus in a little bit on that traditional IRA. This is one of the most common questions we get on a regular basis. Some people will say, well, you said I could self-direct my traditional and my Roth, but what about my rollover IRA? Great news. A rollover IRA is just another name for a traditional IRA. So yes, a rollover IRA can be self-directed. And as far as the tax treatment goes, a rollover IRA is treated exactly the same way as a traditional IRA. So keep that in mind. And I'm sure some of you may have rollover IRAs that you moved old retirement plans or old 401ks into. Those can be self-directed right now. You don't even have to wait. That's something that you can open up and get started with right now. Again, book a phone call, guys. Those calendars get filled up, especially near the end of the year. So if you're trying to meet certain deadlines, be sure to book that phone call so you can talk to us one-on-one and we can walk through and cater the overall situation just for you. Let's talk a little bit more about some more retirement accounts. So we've got the Roth traditional and HSA, as I mentioned before. And now 2 of those boxes have a beautiful little star in it. We'll talk a little bit about how those are tax-free in growth, okay? So there's different tax treatment for different types of retirement accounts. For example, on your Roth IRAs, when you contribute to your Roth IRA, you do not get a deduction. Okay. Now, a lot of people are like, well, that sucks. I need the deduction. Well, we'll get there. Not to worry. There are opportunities to get deductions on other types of retirement accounts. But by not taking the deduction up front with the Roth IRA contribution, you are setting yourself up to earn tax-free income for the entire lifetime of that Roth IRA. So think about it like this. You're paying taxes on the contributions because you're not getting a deduction. The contributions are the seed. So you're paying taxes on the seed. The good news is that that seed is going to grow into hopefully an orchard of some kind. I don't know, apple, whatever you'd like. But that orchard is not going to be taxed. So you want to pay taxes on the seed versus the harvest. Pay taxes on that $5,000 you put in, not the $100,000 you take out in 20 years once you've grown it to that level. So that's what the Roth IRAs. Really, really beneficial to have. I think everybody should have one in their tool belt. Whether you're maximizing contributions there or not is up to you and your CPA. But if you can afford to forego the contribution deductions, Roth IRA is a great option to consider. Next up, you've got your traditional IRA. The traditional IRA is the most common account type we open up here on a daily basis. Contributions to a traditional IRA are potentially deductible. We say potentially because it doesn't happen every single time. There are some watch outs there, and we can walk you through when you would or would not be able to deduct the contributions to your traditional IRA. If you can deduct your contributions, that's going to give you a nice little tax break at tax time. However, that means that the earnings attributable to that particular balance in that IRA, it's going to grow tax deferred, not tax free. So similar to the Roth IRA example, if you put $5,000 in, you're going to get a deduction for that. So now that $5,000 is going to grow tax deferred, meaning you will not pay taxes on a year-to-year basis just because the income is coming into your IRA. You'll only pay taxes when you actually take a distribution in retirement age. If you take out funds from your traditional IRA before retirement age, you may be subject to taxes and penalties. But if you wait until retirement age, you'll just only owe the taxes. Now imagine if you would have just done the Roth to begin with. What size of account would you have today? How much tax-free money would you have at your fingertips today? However, the traditional IRA, again, is one of the most common types of accounts that we see on a regular basis. It's probably because it's the easiest one to move some money into. I know there's a lot of retirement accounts that typically move into a traditional IRA. Daniel, did you want to touch on that?
Yeah, so I wanted to just elaborate on the example, which is if you put $5,000 into a Roth, sure, you pay taxes on it. Technically, it's a little bit weaker of a dollar, right? As opposed to a pre-tax dollar. But when you grow that to $500,000, you pay no taxes on $495,000.
Ever?
At the very end of distribution, you're not paying any taxes on that.
That's amazing.
Traditional IRAs, you're going to pay tax for the $5,000 and of the $495,000 you grew. Now, we've all been kind of, I always say, brainwashed into like, oh, well, you're supposed to do a traditional because you're going to be at a lower tax bracket. Well, if I am retiring and I've been making $150,000 a year, I don't want to make $60,000. I want to continue to make $150,000. So I'm always going to be in that $150,000 tax bracket. So I'll be paying those taxes. So Roth is just more beneficial, but it's not the end all be all. If you have an old 401k and you want to start doing self-direction, move it into a traditional. I'd rather retire with a $10 million traditional IRA than no money at all.
Doesn't sound too shabby to me.
That's my outlook.
Thanks so much for that additional elaboration, Daniel. And we're going to touch more on moving the 401k to this IRA and how that works in just a little bit. But he's spot on. Most people have an old 401k, an old 403b, a TSP, something pre-tax from their employer or a prior employer. And once they leave that employer, they forget about it. They forget that they can actually move it. That money is theirs. So it's really, really good to be aware of where all of your retirement accounts are, even as you move between different employers, and make sure that you are able to roll any pre-tax dollars into a self-directed traditional IRA or a normal IRA. It's up to you. Last but not least is that HSA. The HSA is the best of both worlds. With the HSA, when you make contributions, you get a deduction. But just like the Roth IRA, it actually grows tax-free. So not only are you getting the deductions, just like with the traditional IRA, but you're getting the tax-free growth, just like the Roth IRA. So the HSA is super powerful. That's also a really great tool to have in your tool belt if you're looking for additional deductions, or if you've just got a high deductible health plan and you want to start saving some money that's going to grow tax-free. I don't know about you, but we all have medical bills at some point in our lives. So it's always good to save up and build up that HSA because you don't have to use it and reimburse yourself now. You can always do that later. So the Roth IRA, traditional IRA, and HSA, those are the three most common individual types of retirement accounts that we see on a regular basis. Before we continue, Daniel, did we have any questions in the chat that we should highlight?
We do. I just know we're going to be talking about them a little later, but let's just, I have one gentleman who's asking, can I lend money for my self-directed IRA to a third-party company? They specifically asked about the S Corp, but you can lend money to any company, right?
Essentially any company with some few watch outs that you'll want to be aware of. But yeah, in theory, if Daniel owns a company, Daniel and I are not related. We're simply colleagues. So if I had an IRA, I could loan Daniel's company money and we would agree to our terms. Maybe it's a 6-month loan. Maybe it's a 6-year loan. Is he going to pay me back 5%?
I'm going to pay you back monthly.
Yes. I said 5%. You didn't even hesitate. You're like, yes, single digit sounds great. I'm like, absolutely not. I would have asked for 12%.
Oh, no, I was going to ask for 15 points up front.
Oh, so. There you go. Yeah. So you can craft that deal however you want, though, guys. That's up to you. But so the short answer is yes, you can absolutely lend money to a neutral third-party company as long as there's no relation there. Now, if Daniel was my son, then no, my IRA cannot lend to my son's company, and we'll touch on disqualified parties more later on. Any other questions you want to hit right now, Daniel?
Yeah, I do have one I think we can kind of discuss, which I think should be a quick answer, which is how long do you have to wait to take a tax-free distribution?
Oh, that's the 5-year rule. So 5 years plus hitting 59 and a half. So as long as you've got the Roth IRA set up and contributed to, you've got that 5-year clock starting. Okay. Once you hit 59 and a half, tax-free distributions can come out, but there's an exception. Do you know what the exception is, Daniel?
For the tax-free distributions? Well, you said the 5-year rule, 59 and a half.
Yes.
What other exception are you
It's on
looking
the
for?
contributions.
Oh,
So when it
yes.
comes to the contributions that you deposit into the accounts on a regular basis with these Roth IRAs, those are your Roth IRA contributions, you're actually able to access those contributions sooner, before 59 and a half. So keep that in mind. All that money that you're putting in, you can actually take that principal out. It's just the earnings attributable and any conversions or things like that that you got to watch out for. But great questions.
Yeah, and Cynthia, you're obviously not asking a question, but you're being a know-it-all. So please stop. She got the answer right.
Cynthia, gold star. Love it. Thank you so much for engaging in the chat with us. We really appreciate it. We love seeing when people know answers too. So sounds like you're a pro. All right, let's talk a little bit more about some other types of retirement accounts that you can self-direct. We've already touched on the Roth, the traditional, and the HSA. Now let's talk about some of the different retirement plans that can be self-directed by small businesses. If you are a small business and you have no full-time employees, the solo 401k might be a great option for you. If you do have employees, a SEP IRA may be an option for you. With the solo 401k Roth that you see there on the left, much like the Roth IRA, that's going to grow tax-free. So even though the contributions are not always deductible, the earnings on those contributions does grow tax-free. So just like the Roth IRA, money goes in, you don't get the deduction, and it grows tax-free until you take it out. Once you start to take withdrawals, you still do not pay taxes, ever. There's no catch. Okay. Next up is the solo 401k traditional. So you've got two components to the solo 401k. The good news is that the solo 401k is just a normal 401k, guys. So if you've had a 401k in the past with a prior employer, you know the drill. There's employee contributions, there's employer matches to the contributions, and a whole bunch of other fun stuff going on in there. So the good news again, though, is if you know what a 401k is, you already know what a solo 401k is. So if you're someone who's self-employed and have no full-time employees, maybe just your spouse or your child, as an example, those are exceptions. But if you have no full-time employees and it's just you and your spouse doing your thing, maybe you guys are property managers or something, you can set up a solo 401k. We hate to see people not take advantage of the solo 401k when they're self-employed because they're leaving a lot of money on the table. You don't have a traditional employer offering a 401k to you. So we always want to make sure that anybody who's self-employed is aware of this option. It's a really great tool to have in your tool belt in addition to the Roth and the traditional IRAs. So not only can you do these individual accounts, the Roth IRA and traditional IRA and HSA, if you're self-employed, you can also do the solo 401k as well.
Another page on the menu.
Absolutely, just another page on the menu. This menu is starting to look like a cheesecake factory. I gotta slim it down a bit. All right, so the SEP IRA, so just like the solo 401k traditional, when you make contributions, those are potentially deductible and the earnings are gonna grow tax deferred. So out of the three that you see here, the only one with a star indicating tax-free growth is that solo 401k Roth. Your solo 401k traditional and your SEP IRA are gonna grow tax deferred. Now again, pros and cons to each. Book a phone call with us. We can walk you through the pros and cons and see if we can help cater it to your particular situation. But it's always also good to pull in your CPA or tax professional as well, because they're going to know your tax situation and your income situation way better than us. So our role here is to help guide you and share the pros and cons with you. But we're not going to say you need to open up XYZ account for your situation. That would be tax advice.
And it's also a really good way to figure out if your CPA is worth the money you spend on them.
Great point. That's a really, really great point.
They should know this stuff.
Absolutely. Absolutely. They really should. So if you ask them and they don't know, we'll help you find a new one. We've got a list of tax pros to get you as well, thanks to Mark J. Kohler. All right. So last but not least, we've got some additional kinds of accounts that you can self-direct. And we just covered the top 6. the biggest ones, but as you can see, there's a lot more types of accounts that you can self-direct with us as well. So this is nearly an all-inclusive list, but you've got your kids' Roth IRAs. I feel like those are on the rise more and more. I feel like more people are learning about those.
Yeah, and I hate that they get like glossed over because the kids' Roth can be used for things like higher education, like putting the down payment on your first home, some medical expenses. There's some more stipulations on that one, but these kids' Roths can be grown rapidly before they're even 18, just as long as they can show some sort of earned income. And if you're doing the investing, why not just bring your kids' Roth on with you and invest that thing along with it?
Absolutely. You know, we see a lot of people adding their kids to their board of directors for their company or small business. Maybe you've got a kid that does lawn mowing and babysitting. We also see people that hire their kids to do some artwork, maybe for marketing purposes. But if they're on your payroll, there's a deduction. If you have that money go into a Roth IRA, now your kid is going to be set up with a Roth IRA. That 5-year clock is going to start right away. And their compound interest and tax-free growth is going to be exponential. So definitely check out the kids' Roth IRA if you're looking for more ways to save, more deductions, and just more capital to infuse in some deals that maybe you're already working on. Have the kids come along for the ride as well.
It's also a good way to teach them how to do this stuff too. You want to get them young. I wish I would have known this stuff when I was younger.
Absolutely. You know, I'm so blessed that my father actually taught me about IRAs and investing in my early 20s. And I shared with all my friends because no one had any clue how to buy a stock or anything like that. So
if I would have known about the HSAs when I was younger, now I actually have to use my medical. So now I'm like, okay, what can I put off while I invest my HSA and do all these things? So I had an HSA when I was in my 20s and I was like, I don't need medical. What am I doing with this thing?
To be young. In addition to the kids' Roth IRA, you can also self-direct inherited IRAs, simple IRAs. You've got your 401k plans and your ESAs as well. The ESA is an education savings account. It's also known as a Coverdell. It's an alternative to the 529 plan. The 529 plans cannot be self-directed, guys. The ESAs, also known as the Coverdell, can be self-directed.
Simples. Can simples be rolled over? I had one gentleman who asked about his simples, so I said, I'll bring it up. It's not super common. Simples are not super common, but they can be rolled over to a self-directed IRA.
Absolutely. So we do not support simple IRAs here, and that's because they're not quite simple. No, I'm just kidding. They're really not that super simple, though. So we have the SEP IRA as an alternative and the solo 401k for people who are self-employed and don't have employees. With the simple IRA, what I would say to that is, yes, you can roll it over. There is a 2-year waiting period. So once you have the plan established, you have to wait 2 full years before you can move it to avoid some pretty hefty penalties. So keep that in mind. But that simple IRA can go into a traditional IRA, a SEP IRA, a solo 401k traditional. You can certainly move that simple IRA and self-direct it immediately as well. That's definitely permissible. You'll notice too on this list, I've got solo 401k after tax, and I also have 401ks and pensions. Now, we do not provide you with the 401k plan and the pension plan documents in order to self-direct. This is a very rare occurrence, but we have seen people do it. People that have, 5, 10 employees, they set up their own 401k plan and they allow for self-direction in this full-blown 401k plan. So that is an option. It's out there. Pensions as well. And then those solo 401k after tax, that's a really great option for people if you're looking for more places to maximize your contributions and savings. So if you're maxing out your IRAs and you're maxing out your solo 401ks, let us know. We can talk about the after-tax option if you are at that point. So yeah, any account type really can be self-directed. So sky's the limit, guys. Now, I know we said before that we cannot determine which account type is best for you. We're not going to pick it for you and give you advice, right? But we'll do our darndest to try to guide you in the right direction and maybe explain some pros and cons. So for example, if you have a Roth IRA at Fidelity right now, first of all, I'm sure there's lots of you in the chat with a Roth IRA at Fidelity. But second of all, if you do have a Roth IRA at Fidelity, that money is yours to do with as you please right now. The reason I point that out is because there may also be some of you on this particular webinar that have a 401k plan with their current employer. Those are a little trickier to get out of the possession of your employer and into an IRA to self-direct. We'll talk more about rollovers momentarily, but just be aware that any of these traditional IRAs and Roth IRAs, that is your money. You can self-direct it today. So I don't care if it's at Fidelity, Schwab, anywhere in the world at your bank, credit union, etc. If it's an IRA, you can self-direct it right now. The cool part about it too is that if you have a Roth IRA at Fidelity and you open a Roth IRA here, it's just a simple transfer and there's no taxes due and there's no penalties due. Now, that's the number one option if you've got a Roth IRA, and that's because the IRS forces you to keep that as a Roth IRA. You can't combine it into a 401k Roth or solo 401k Roth. A Roth IRA is a Roth IRA is a Roth IRA. So the Roth IRA is always going to remain as one. So in other words, I'm not telling you to open a self-directed Roth IRA here. I'm just letting you know that that's essentially your only option if you have a Roth IRA. So if you aren't looking to establish a brand new type of account, you can simply open a Roth IRA with us and move over the Roth IRA that you had at Fidelity. Very easy to move. There's no taxes or penalties. Similar situation when it comes to your traditional IRA. If you've got a traditional IRA at Fidelity right now, or a rollover IRA, remember those are one and the same, a traditional IRA or a Roth IRA, or excuse me, a traditional IRA or a rollover IRA at Fidelity, either of those can be moved into a traditional IRA here with us. No taxes, no penalties. Now, it's important to note though that with the traditional IRA, this is not your only option. When it comes to a traditional IRA, since it's not a post-tax account earning tax-free growth, there are still ways to quote unquote make them better or choose different things depending on your tax situation. So if you have a traditional IRA or a rollover IRA right now, moving it to a traditional IRA here may be the best for you. Again, no taxes, no penalties. Sounds pretty nice. But if you have a traditional IRA now, but you want a Roth IRA, you would have to do that in two separate steps. We combine these steps for you into one set of documents and paperwork, so it's super easy to do. But if you would like to have a Roth IRA, but you currently have a traditional IRA, all you do is open a traditional IRA here with us, and then you open a Roth IRA here with us. We would then perform what's called a Roth conversion. I'll touch on the conversions very lightly, only because it's the end of the year. And the conversion deadline is coming up as of December 31st for the year. But with the Roth conversions, you are welcome to convert all or some of your traditional IRA into a Roth. Now, why would people do that? What is the conversion? A Roth conversion is simply saying, hey, IRS, I have some pre-tax money, but I want it to grow tax-free now. So we push some buttons in our system after you tell us you want to do a conversion. We'll take whatever amount of the balance you'd like. So whether that's 1% of your balance, 50% of your balance, 100% of your balance, you can convert it in pieces or you can convert it all at once. But it's extremely important to remember that you are likely causing yourself an intentional taxable event. So if you've got a traditional IRA that's got $100,000 in it, and you decide that you're going to convert the entire thing, it's best to work with your CPA or tax professional to time out when you do the conversion and how much. For example, let's say maybe next year, early January, you get laid off or you decide a premature retirement is in the plan for you. But you plan to take the entire 12 months off and just explore. Fine, do that. That means you may not have any taxable income for the entire year. So if you're going to convert, some people may look at that situation where they have lower income for the year or no income for the year, and they may choose to convert in those years because they're not pushing themselves into a higher tax bracket. So those people may convert $50,000, $10,000, $100,000, but they're going to be taxed at the rate in which that puts them in for the salary ranges on the federal tax brackets. So a lot of people will say, when I do a conversion, what's my tax rate? No, trick question. It's going to be whatever tax rate it puts you into. So if you make no money right now and you have a conversion of $100,000, that's going to be counted as $100,000 of income. That $100,000 will be taxed. If you already have $100,000 of income, and you convert an additional 100,000 from your traditional to your Roth, well, now that's going to be equivalent to $200,000 that you're going to be taxed on as if it was income for the year. So keep that in mind. It's not a specific tax rate that's applied to the conversion. It's just whatever tax bracket you end up in based on the dollar amount that you're converting and whatever income level you're at. So when it comes to the traditional and the Roths, you do have the option of moving the traditional into a traditional, plain as day. Nice and easy, no taxes, no penalties. But you also have the option of converting from a traditional to the Roth. Now, as you see there, that's when taxes will be due. Now, there's no penalties due as long as you do it correctly, and we'll guide you through that. But there will be taxes due. So you're essentially saying, hey, IRS, I want to get the taxes out of the way now so that this seed grows tax-free for forever. So that's absolutely an option. Next up, we're going to talk a little bit about moving money between different types of accounts. Maybe you've got a traditional IRA over at Fidelity and you've got your eye on the solo 401k traditional. That is absolutely permissible to do. And that's because both kinds of accounts have the same tax treatment. The traditional IRA is pre-tax and it grows tax deferred. The solo 401k is pre-tax and it grows tax deferred. Because of that, that means you can take your traditional IRA at Fidelity and roll it into a solo 401k traditional here with us. No taxes due, no penalties due. I'm seeing a trend. There's no taxes or penalties due for most of this, which is fabulous because we get that question all the time. Any questions in the chat that we want to touch on before I jump in to the next slides here?
A lot of them are on investments and what to do with them. So I think we should hold off because I know we got some slides coming up for them. So let's get into those.
Awesome.
And then I'll chime in with their questions.
Perfect. Yeah. Thanks, guys. Keep those questions coming. We really appreciate you. Okay, last but not least, we've got this traditional IRA to solo 401k. I apologize. There's one more after this even. So you've got your traditional IRA. You can move that over into the solo 401k traditional. That's, again, no taxes, no penalties, nice and easy. But just like the traditional IRA conversion, you do have an option to convert if you would like. So if you've got a traditional IRA with Fidelity right now, you can open a solo 401k traditional and Roth with us. You can move that traditional IRA into the solo 401k traditional, no taxes, no penalties. You can then also choose to do a conversion from the solo 401k to the solo 401k Roth. So just like with the traditional IRA to the Roth IRA, when you do this, you want to plan accordingly. Most people choose to do it in a year in which they have no income or little income, so it doesn't push them into that tax bracket, that next tax bracket. But same as before, it's completely up to you. Work with your tax professional because there are a lot of options. If you book a phone call with us and ask us about these things, we're going to be able to walk you through everything step by step and explain it, but we're not able to make recommendations or advise.
Or tell you what you're going to owe on taxes.
Oh, yes. Unfortunately, we can't. Yeah. Usually when we say, I can't tell you how much you're going to owe in taxes, they say, but I have a W-2 of this, and then I have self-employment income of this, and that they want us to calculate it. And I'm so sorry, that is above our pay grade. Speak with your CPAs and your tax pros on that. We don't want anything to get messed up there for you.
Definitely.
Last but not least is the HSA. If you've got an HSA with Fidelity, you are more than welcome to simply move that to an HSA here with us. Now, I know, Daniel, you mentioned that it's not possible 100% of the time, but most of the time, right?
Yeah. So when we're talking about like rolling over and moving things, I always let people know if you're trying to roll over or do an in-service rollover with your current employer, a W-2 sponsored 401k, more than likely that's not going to happen.
Sure.
Reach out to your benefits team, reach out to your HR department, figure out if you can. More than likely it's not. HSAs, guys, if you want to self-direct these things, it's the exact opposite of what I said with the 401ks. An in-service transfer over to us from your current W-2 sponsored plan, that can most of the time,
like 97%.
97% of the time is going to come over here. There are some caveats. Sometimes they're like, oh, can you just keep $1,000 in here? Fine. Keep $1,000 in there. Maybe use that to buy some Advil every now and then. But if you want to self-direct your HSA, you can transfer those over while you're with your current employer. I just want to emphasize that.
Easy peasy. And when you do that, there's no taxes due. There's no penalties due. I'm, again, starting to see this awesome trend here. Just because you're going to self-direct doesn't mean you're going to get hit with taxes or penalties, which is great news for everybody.
I know we're going to be getting into assets here soon, but I keep getting this question asked about fees trading on our platform. I just want to reiterate to everybody, this is self-direction. You are going out, you are finding your investments.
There's no trading platform.
We are not a trading platform. We are a custodian, and we're a damn good one at that. Okay. And that's what we focus on, is being the best custodian for you so you can go out and find your deals that you specialize in. That's what we want.
Absolutely. Thanks for that reminder, Daniel. So just to recap that piece, guys, keep in mind the people that book calls with us and open accounts with us, it's because you're looking to invest in investments of your choice that you find. So this isn't an opportunity for you to log into our website and view a menu or a list of different investments that are out there. If we did, it would be endless. Can you imagine, all the different private lending deals in real estate and crypto, etc. So we can't give you a menu of what to invest in, nor will we ever tell you what you should invest into. That's up to you. But for the people that are already doing private lending or investing in syndications, or maybe you're a developer or just a real estate investor in general, maybe you've got some short-term rentals, you're an Airbnb person, you can do all of that in your self-directed IRA with us. We're just not going to choose those properties or strategies for you and pitch them to you. We do not sell investments here ever.
And one good one to touch on. Question, how do you qualify for an HSA? And that's going to be your insurance provider. So you're going to need a high deductible health plan that's HSA eligible, and that'll be. And this person says they're self-employed. I'm not sure when the open market closes. Open enrollment closes.
Yeah, it might have.
But for self-employed people, you're usually going to want to be looking around like November, early December time. I can't remember exactly.
Yep.
I'm not an insurance person. Okay, I'm an IRA person.
Thank goodness.
Yeah, but
just getting to all of our insurance pros out there. You're great.
That's where you're going to want to look, is high deductible health plan, HSA eligible, and you'll be able to set that up.
Beautiful. Thank you so much for that. And again, we want to encourage everybody to just book a phone call too. So if you've got a lot of questions, let's cater these answers one-on-one with us. That's literally what our team is here for. So book as many calls as you need. Daniel loves it when he gets multiples, in a row, because he's knocking out all those questions back to back to back and getting you in the best position possible. Yeah. Absolutely. That's what our team is here for, though. Pick our brains. It's free to pick our brains. All right, let's talk a little bit about moving money to your new retirement account. So there's no crazy trick to it, guys. You're going to be moving money into your self-directed retirement account just like you would with any other retirement account at any other institution. So there's three main ways to move money into your accounts. You can do a rollover, you can do a transfer, or you can do an annual contribution. All three of those methods are available to you based on the different account types that you have and what account types you're moving between. Let's talk a little bit more about the rollover to a directed IRA account. So what exactly is a rollover? A rollover is when cash or investments is moved from one kind of retirement account to a different kind of retirement account. For example, if you've got a 401k right now and you want to open up a traditional IRA, moving money from a 401k to an IRA is considered a rollover. And that's simply because it's reportable. Okay. Now, just because it's reportable, it doesn't mean it impacts the tax treatment. So just like with the moving different accounts, as we talked about before, no taxes, no penalties, it just is reportable. All that means is Fidelity is going to issue a 1099-R and Directed IRA is going to issue a 5498. It's just letting you know that money moved, and it's letting the IRS know that money moved. That's all there is to it. In order to move over your pensions, your 403Bs, your TSPs, any type of employer plan, you will actually be facilitating a rollover. So you can move those pensions and 401Ks and such into a traditional IRA here at Directed IRA. Now, you facilitate all of this with the current institution that you're at. So if you have a 401k at Fidelity, you'll just call up Fidelity, let them know you want to do a rollover, provide them with the instructions to write the check out to your new IRA, and that's essentially it. Same thing with your pensions. You'd call Charles Schwab, you'd tell them your intent to do a rollover, and they'll guide you through that process as well. You'll find each company is a little different on how they do things. Some people or some companies might accept your direction over the phone. Some of them might require a form. Just varies based on the institution that you're working with. Either way, it's all super easy to accomplish. Last but not least, if you've got a 401k Roth, which is becoming more and more common ever since the Secure 2.0 Act. If you've got a 401k that's Roth at Fidelity, you can move that into a Roth IRA here at Directed IRA. Once again, all of those examples, when you're doing a rollover and you're doing it properly, there are no taxes due, no penalties due, and it's not reportable, and it is reportable. Doesn't mean there's any taxes or penalties due though. Let's talk about the transfer. Before we jump into the transfer, did we have any questions about rollovers specifically?
No, I had one gentleman who asked, can union pensions be rolled over? Pensions or pensions?
Yeah.
Pensions or pensions. They'll be able to be rolled over.
Union or not, doesn't matter. It's a pension. You are able to roll that over. So the key is that when you have a 401k plan or a pension, if you're still employed, the chances of being able to roll and move that money is very limited. I would say roughly 90 to 95% can't move it. There are some exceptions, so it doesn't hurt to ask if you can do an in-service rollover. Some plans also say once you hit age 55, it's yours, even though you're not at retirement age or left the employer. Even if you're still employed, maybe when you're 55, the plan documents sometimes allow for you to self-direct at that point too, take some money out into an IRA. So if you have an existing employer plan with your current employer, please contact them and ask them if you are able to do an in-service rollover, because the answer may be no, and that's going to be just based on your plan documents with them.
And if the answer is no, you can still open up a traditional or a Roth.
Absolutely.
Or an HSA if you qualify.
The best part is that even if your 401k that you're thinking about right now that's got 6 figures in it and you'd love to self-direct that, if you can't touch it right now, not only will you absolutely be able to roll it into self-directing in the future once you're separated from service from that employer, but today, right now, you can still do the Roth, the traditional, or the HSA IRAs. So your Roth IRAs, your traditional IRAs, and your HSAs are still an option immediately, even if your 401k is locked up with your current employer. All right, talking about transfers now. A transfer is one of my favorites, and that's because it's not reportable. It kind of just happens under the radar. A transfer is when cash or investments is moved between two types of accounts that are the same. So, for example, you've got your traditional IRA to traditional IRA, your HSA to HSA, your Roth IRA to Roth IRA. No taxes due, no penalties due, and it's not reportable. The good news about the transfer as well is that we help facilitate this for you. So with the rollover, the ball is really in your court. We're tied to waiting on you to make the phone call in order to initiate the rollover. With the transfer, you complete our transfer form, and then we contact Fidelity. We contact Charles Schwab, and we facilitate everything for you to get the account moved over. The other big question I get on a regular basis is, do I have to move my entire IRA if I self-direct? The answer is no. You can self-direct 1% of your IRA, 50%, 10%, 70%, 89%, 99.2%, 100%, whatever you'd like. Okay.
But I want you guys to know, though, it's a gateway drug.
It is.
So you're going to start self-directing.
Everyone starts with a little.
Yeah.
And then before you know it, they've got their whole portfolio over here.
You're going to end up moving it over. You're going to do one private money loan. You're going to get 12% in 9 months. And you're going to be like, why have I not been doing this the whole time?
Absolutely.
So just be prepared. You could do partial, dip your toe in the water, make sure it's warm or how you like it. You're going to eventually move it all over anyway.
Yeah, we're telling you right now, no need to test the water. It's a good time. It's a lot of fun to self-direct, and we hope you join us, whether it is with 1% of your portfolio or 100. So that's a little bit about the transfers. Thank you so much for that additional insight too, Daniel. Let's talk now about contributions. That's the third way that we can actually move money or assets into these retirement accounts. So a contribution is simply the ability for you to take money out of your personal income, out of your personal bank account, and deposit it into your retirement account. That's all it is. The IRS does set a maximum though. So because these are tax advantaged accounts, the IRS has a limit on how much you can actually put in these accounts. So unfortunately, it's not thousands and thousands and millions that you can put into these accounts, because I know we all have just, 6 figures pocket change laying around looking for something to do with it. The good news though is that there are different levels and ranges of contribution limits depending on the account type that you have. So if you've got a Roth or a traditional, as of this year for 2025, if you're under the age of 50, you can put in up to $7,000 maximum. Not super mind blowing, but it's a starting place, and it's a great starting place. So you've got your Roth IRA and your traditional IRA. If you're under 50, you can do $7,000 into those. If you're over 50, lucky you can do $8,000 into those this year. But with your solo 401ks, you can do up to $70,000 if you are under the age of 50. So that just gives you tenfold the amount that you can contribute. So remember what I said earlier, if you're maxing out the solo 401k and your IRAs and your HSAs, you may want to explore that after-tax option on the solo 401k. But this is a one-on-one session, so we're not going to dive too much into that. Just keep in mind there's always ways to add more and contribute more. Yeah.
But Lindsay, what if I have multiple Roths, multiple traditional IRAs? Can I contribute $7,000 to all of them?
Oh, great question. Trick one. No. The answer is no. It's aggregate. So I don't care if you've got 10 IRAs or 1 IRA or 50 IRAs. There are people out there that have 50 IRAs.
But Lindsay.
No.
I also contribute to a 401k with my W-2 sponsored job. Can I contribute to an IRA?
Absolutely. So just because you max out your 401k doesn't mean you can't max out your IRA. Just keep in mind it's aggregate. So amongst all of the IRAs, your Roths and your traditionals and those rollover IRAs are the same thing. Out of all those account types, you can only put $7,000 in per year amongst all of them.
But Lindsay,
no.
I did an investment and it made me $10 million. Does that count towards my contribution limit for the year?
It doesn't. And that's a really great point, and another often question that we see regularly. So a lot of people get concerned because they're like, well, the IRS says I can only put $7,000 in per year. Good news, the earnings attributable to the investments you make do not count towards your contribution limits. So not only can you earn as much as you want, there's no ceiling to that based on the balance that you have and the investments that you make. You can also add in another $7,000 every time. Okay. Great input there. I really appreciate that. And I love you know what, great questions though, because these are things that we get on a regular basis. People often confuse the contribution limits with the earnings attributable. Earnings on the investments, endless. Contributions maxed at $7,000 on the IRAs. And the HSAs, you've got your $4,300 versus the $8,550, depending on whether it's an individual or family plan for your contributions. Now, a lot of people will typically combine 2 or more of these different methods. So everybody likes to do number 3, because who's not maxing out their annual contributions? Daniel?
22-year-old me was not thinking about this. I'm sorry.
We were not back in the day, but now everybody thinks about it and they don't want to miss it. So annual contributions, those are due at tax time for the prior year. So you can make your 2025 annual contribution all the way up until April 15th. But why would you want to wait to do that and lose out on 4 months of compound interest, guys? You can still open your retirement account and contribute right now. So most people will use number 3, that's the annual contribution, and then they will typically use a combination of 1 or 2 with their contributions. So for example, maybe you've got an old 401k with your prior employer and you also make a contribution. So that would be a combination of number 1, the rollover from a 401k to an IRA. And then number 3, that's just, again, your annual contribution to your new IRA. So most people will combine some of these. It really allows you to maximize the capital that you can self-direct and tuck away into those retirement accounts.
And another one, just because I said we don't talk about children's Roth accounts enough. If you have a children's Roth account you've been doing with Fidelity, you can transfer that over. It becomes a minor Roth account with us, and you can start self-directing that. So just remember, you can move it. Transfers are like to like. You got a traditional IRA, you got a Roth IRA, they're going to go to the same account. 401ks are rollovers, different plan to a different IRA.
Beautiful. Thank you so much for that. All right. Last but not least, we're going to talk a little bit more about investments again. So in this particular example, we're going to run you through an example of an investment that Daniel made hypothetically with his Roth IRA. He's laughing because I picked the property. You guys are going to love it. It's a great property. All right. So as we said before, with the diverse investment options, you can do real estate, you can do RV parks, commercial buildings, you can have Bitcoin, you can lend, you can do gold. The sky's the limit. There's really no end to what you can actually invest into. So let's look at one example of somebody who's investing in real estate with their Roth IRA at Directed IRA. This is a Zillow listing. This is an actual real Zillow listing. And this is from a listing out in Flint, Michigan. I was actually born just on the outskirts of Flint, Michigan. My family got lucky though. We had well water, so we weren't impacted with the water situation out there, which is just awful. But when it comes to Flint, as you can imagine, it's pretty affordable still. With this particular listing, what you're looking at is a $55,000 building, 4 beds, 2 baths. It's actually a duplex. So there's 2 units in this property. Let's talk a little bit about what it looks like to own this duplex as a long-term rental in a Roth IRA.
Lindsay, I just want to say, because I'm confident we're going to get questions on this.
Yeah.
Make sure you guys put those questions in the Q&A box. Okay, and we'll be addressing them live. But I already know that there's asset questions, and I know there's going to be lots. So make sure you put them in the Q&A.
Thank you so much. All right, questions. We are expecting those here shortly. Let's run through this duplex long-term rental example of what it looks like to own this in a Roth IRA. So Daniel has a Roth IRA and he's got $100,000 in it. Okay, and we like round numbers here for sake of example. So we're going to stick with $100,000 even. Daniel is a real estate investor in the Michigan area. Hopefully there's some Michiganders watching, maybe some Flintstones as well. When it comes to the investments that you are choosing for your retirement account, that is really the key. You are choosing it. So as we mentioned before, we do not have a list of different investments and properties and qualified lenders and different things like that we think you should invest with or partner with. You, Daniel, in this case, went to Zillow and found this property that he is going to buy. I, Directed IRA, did not choose this property for him. I did not tell him this was a good deal. I did not run calculations on what's the ARV going to be, we didn't do any of that for him. Daniel is a real estate investor. He's a pro. That's what he does all day, every day. It's up to Daniel to choose the property, review the property, and do all that due diligence. Now, Daniel's going to purchase this property with his Roth IRA. So $55,000 comes out for the purchase price, $5,000 worth of expenses because real estate. And that leaves $40,000 left in his Roth IRA. But how does he get there? The first thing Daniel's going to do is he's going to go to our website. He's going to log in on directedira.com. He's going to log into his client account and he's going to click the invest button. When he does this, he's going to be prompted to provide us with all of the details about this real estate transaction. We're going to ask, where are we sending the money? We're going to ask for the purchase agreement. We're going to ask for the wire instructions. We're going to ask all of these details about his real estate deal. He's going to type all that in online. And then once he submits it to us, we're going to get a request that essentially says, hey, Lindsay, Daniel would like you to send out $55,000 and here's why. He's going to have all the purchase agreement and everything for us. We're going to review everything and we're going to say, yep, looks good. We're going to send the money out for you, Daniel. We'll send the money out and then now his IRA owns a property. Did I make that easy enough? I feel like I missed a bajillion things. That's a high level.
I think that's actually perfect. And I think the next slide is where I want my real estate investors that are here right now to really pay attention. Because this is when I give my lectures across the country to RIAs. Mm-hmm. This is where people get hung up. They cannot separate themselves from their IRAs.
Okay, love it. Let's dive right in. So we've got this example again where Daniel owns a Roth IRA. But if Daniel is going to own this Roth IRA, if Daniel's Roth IRA is going to own this real estate, then that means Daniel does not own it personally. So on your typical purchase agreement, the purchaser is going to say your name. But on a purchase agreement for an IRA investment, it's going to have this really unique titling. Now, I made the mistake of putting this text in black. So please Get real close to the screen, guys. The titling for the buyer is Directed Trust Company, FBO, Daniel Tercey, Roth IRA.
And we're going to write it over all of the text as well, just like that. So it's real sloppy for everybody.
Yes, thank you. He's making fun of my example. I swear I pulled this purchase agreement off Google. Don't
So
use this.
bad.
This is not an example to use, guys. I just, just for sake of example, we can't use proprietary.
But it is this is the separation that I was talking about. You do not own this. Your IRA owns this. Real estate investors and new real estate investors that are watching this to learn how to do it, you are taxable. Daniel Tercey is taxable. Directed Trust Company, FBO Daniel Tercey, no longer taxable.
Exactly. Yep. So that titling is really critical. And what I'll say to you guys is that is the number one mistake that holds up deals on a regular basis. We will say it until we're blue in the face. The purchase agreement has to say your IRA is titling. So let's look at that titling once more. So just to kind of recap, you've got Daniel. He's got a Roth IRA. His Roth IRA now owns 936 Lincoln Avenue in good old Flint, Michigan. And he's got $40,000 in cash. That's what his Roth IRA has. But just to clarify, one more time, that deed, the deed for this property that we see right here, the 936 Lincoln Avenue, the deed is going to reflect the property owner as Directed Trust Company, FBO, Daniel Tercey, Roth IRA. The deed and the purchase agreement do not say Daniel Tercey as a single individual, okay? So that's the key when it comes to making your investment successful, is ensuring that the titling is always correct. It would be Directed Trust Company, FBO, Lindsay Mercino, traditional solo 401k, or Lindsay Mercino HSA. Whatever account type you have, that's the account type that goes there at the end. But this titling ensures that it's nice and clear for all parties involved. This entity is not taxed. This income is not taxed. I do not personally own this. Clear as mud? Hopefully.
I think it's clear as day. But we'll see on the phone calls
Giving me too much credit. Yeah, we'll see. So Daniel's got this lovely duplex. It already has renters in place. If you actually go and look up the Zillow ad for this is all true, guys. So the duplex does have renters in place. It also has been on the market for over 120 days. So maybe there was some negotiation there that Daniel did to get it down a little more. But these units rent for $950 a month. That's a rough estimate based on what else I saw in the market in the Flint area for this size of a property. So we're going to assume he's making $950 per unit. That's $1,900 in rental income each month. Daniel's making $22,000 plus per year in not rent-free, in tax-free income. So because he did this in his Roth IRA, all of that income goes back into his Roth IRA. So his renter is going to write a check to his IRA. Why does that check not go to Daniel specifically? Because Daniel is not the owner of the property. His IRA is. So those are two really big points that I have on this last slide here for this real estate example. When it comes to all income produced by the duplex that's owned by the IRA, all that income has to go back into the IRA. Okay? When it comes to all expenses incurred by the duplex, maybe you've got some property taxes due. Maybe you have to pay a plumber to come and fix the toilet. All of those expenses have to be incurred by the Roth IRA as well. So any income comes to the Roth IRA, any expenses come out of the IRA. That's also key. Now we've got a couple of tips and tricks we'll cover, and we're going to really highlight number 3 for you. But the number one thing to remember, guys, is do not get analysis paralysis, please. If I had a dime for every time someone called me and said, Lindsay, I wish I would have done this 2 years ago when we first spoke, guys, I would be retired by now with millions in my pocket. So please don't be that person. Don't get analysis paralysis. Just book the phone call. Just open the account. Just choose that investment.
This is another thing I talk to my real estate investors. If you guys are doing real estate day in and day out, you guys are doing private money lending, you're seeing these things, open up the account. Be prepared for this. Do not wait for the deal. It takes about a month to do a rollover. It can take 2 to 3 weeks to do a transfer. Have the account set up and ready to go.
I've seen people do it in like a week.
Yeah. Well, listen, if you're looking for a deal,
okay, 2 to 4 weeks.
And you're a real estate investor, you need money yesterday. Mm-hmm. Okay, always. And this is for a lot of people. If you wait for the deal and then you try and do the transfer, the rollover, a lot of times it can get hung up and now you're out of the deal. I always tell people, at least you have it open, right?
Yeah.
At least you're ready for the next one. And, you put it out there. a lot of times it'll come back tenfold. So just be prepared for it.
Yeah, I think what a lot of people do these days, especially because we have the flexibility of doing stocks, bonds, mutual funds, and alternatives, what most people will do is they'll open their account, they'll move the funds over, and then they'll invest in a mutual fund for a month or two while they're waiting for a real estate deal to hit. So that's an option. Your money doesn't have to just sit and be sitting there doing nothing. You can at least still have it working for you, even if it's in the traditional market. We also really encourage you guys, as far as these tips and tricks go, to follow our guidance. There are just lots of options and easy ways to mess things up. We're here, and that's exactly what you pay us for, is to walk you through these things step by step. As long as you follow our guidance on how to complete the rollover or the transfer, it's going to go swimmingly, I promise. Last but not least, we also don't want you to wait until you have just enough to self-direct. You don't need 6 figures, guys. We have people that start accounts with $2,000, $3,000. They'll stick it in crypto. They'll stick it in mutual funds. They'll do some private lending for some small deals or gator lending. The sky's the limit, though. You do not have to wait until your account is at $50,000 or $100,000 to self-direct. I know I started with $5,000. So I was able to get in really early with that private equity fund. And then any additional funds that I've accrued, I chose and made the decision to invest in cryptocurrency because I don't need a minimum of $50,000 or $100,000 to do those things. Not saying that's right for everybody, but it was something that was helpful for my situation since I'm not dealing with 6 figures here in my retirement account. Let's talk a little bit more about number 3, and that's the disqualified parties. So what you see here,
people asking prohibited
good.
transactions and such.
All right.
So we do, by the way, hold on. Sorry,
Yes.
Lindsay. We do have a podcast.
Yes.
Or a webinar, that we just did about prohibited transactions.
Yes.
I don't know if maybe one of the hosts or panelists could maybe link that for the prohibited transaction questions. We are primarily going to go over disqualified parties, but we can sprinkle in some of these prohibited transactions because I know we've gone over
They
a
go
little
hand
bit.
in hand. So yeah. Absolutely.
So go ahead and I'll interject them as I see some of this.
Perfect. I appreciate that, Daniel. So when it comes to disqualified parties, this is not really something that a lot of people are aware of if they're not already self-directing. And there's a reason for that. So let's jump right in. When it comes to your IRA is not allowed to transact with certain individuals and those individuals' companies that they may own 50% of or more. So what you see here is a graphic that shows you certain individuals in red and certain individuals in green. Now, when it comes to your IRA and your IRA's investments, your IRA cannot transact with you personally. So if Daniel owns a house personally, his Roth IRA cannot buy that house from him because he's a disqualified party. Same thing happens in the instance of a spouse or a child or a grandchild or a parent or a grandparent or a son or daughter-in-law. All of those individuals are individuals that your IRA cannot transact with.
What if my son owns an LLC, Lindsay, and it's not them who's doing this, it's their LLC?
Same answer. It's a no. So when it comes to these disqualified parties that I just listed off, that's yourself, your spouse, your parents, your grandparents, your children, your grandchildren, and your son or daughter-in-law, all of those individuals and companies that they own 50% of or more of are not able to transact with your IRA. Now, a lot of people think transact simply means money changing hands, and that's not the case. It can also be services that are rendered as well. So if Daniel's Roth IRA owns a house, then his child cannot rent that house from his Roth IRA. If his spouse is a general contractor, then she would not be able to have her company work on the property that her husband's IRA owns. Okay? So you want to be really careful there. Now, a lot of people will also be like, well, shoot, you just took all my ideas and stole the thunder and now I can't do what I was thinking. Good news. We just named maybe 6 different people that you cannot transact with. There's like billions and billions of other people that you can transact with. So keep that in mind. Don't let this burst your bubble. There's still plenty of options out there.
Guys, brothers, sisters, aunts, uncles, nieces, nephews, friends, enemies. You can work with any of these other people, okay? There's so many people you can do business with other than those few that we listed off. I believe there were about 7.
Yes, yes. One of the most common scenarios that people will say is, I want to buy a property next to ASU or, some sort of university, and then they're going to rent it out to their child. Unfortunately, that can't be done, okay? As far as other people renting it out, fair game.
And I'm getting a lot of LLC questions. We're going to keep this basic, guys. I don't know that we're going to go into the IRA LLC. That's the deep end. While it may still be deep end with floaties, it is the deep end.
There are episodes about the IRA LLC though as well.
There are tons. So go to our website. You can check those out. But just know that if you're doing an IRA LLC, things are going to be done in the name of the LLC. And if you are looking to buy real estate, no, you do not need to have an LLC in order to do it. You can do it just through your IRA. I'm going to kind of leave it at that since we've gone over a little bit.
If you have more questions, book a phone call. We strategically did not do the IRA LLC information on this particular presentation because, as Daniel said, this is really 101. But if you are investing in real estate, actual pieces of real estate, not a syndication, not private lending, but if you're actually buying rentals or fix and flips or actual properties, the IRA LLC is really, really good to have in your back pocket. So definitely book a phone call and ask about that, and we can walk you through that as well. So back to these examples of disqualified parties. We've got good old Daniel here. Daniel is the IRA owner, and the IRA is the owner of this beautiful property over in Flint, Michigan. Now, if Daniel is going to have anybody work on this property or rent it out, as we said before, cannot be himself, cannot be his spouse, cannot be his children, cannot be his grandchildren, etc., etc. So these individuals are not able to work on the property and be compensated for it, or stay at the property or rent it out, and neither can their companies. Okay, bunch of nice red X's there. Sorry about the red X on your face, Daniel. Let's see. All right.
It washes me out.
There you go. All right, guys. That is the gist of what we have for you for today. So now what? Make sure you call us. There's only 3 easy steps to start self-directing. Simply open your account, move the money over, and make your investment. So scan that QR code, book a call with Daniel. He's phenomenal at breaking things down step by step for people. I've worked alongside him for years and very excited to see even more of you being able to be assisted by him and experience the riveting experience it is to have Daniel.
We're still talking about IRAs, people. There's nothing crazy on the phone call, okay?
So I'm going to give you guys a little secret. Daniel is a comedian by night. So tell him to tell you guys a joke when you book that phone call, and then share those jokes with me because he's always got some real good ones. All right, guys, thank you so much. Yes, do that. So thank you so much for your time today. Thank you for joining us on this beautiful Tuesday.
I hope to hear from you guys.
Yes, Daniel is looking forward to speaking with you all, and we look forward to helping you self-direct. So until next time, thanks for joining us.
Bye, guys.